Communications and tech surged to ignite a broad market rally today, completely crushing defensive utilities as the Nasdaq jumped over 1.4%. The VanEck Semiconductor ETF rose 2%, Lab scores 53, hold. NVIDIA's Blackwell AI silicon debuts in 6 months, reshaping demand across every tier. Industry fab capacity tightens, adding about 30% pressure on wafer supply chains worldwide. Our deep dive shows how Blackwell will lift margins, shift supply chains, and power the next rally. VanEck Semiconductor ETF surged 2.03% to $604.30. This move reflects a highly bullish short-term trend as the 20-day moving average aligns cleanly above the 50-day line. While mainstream media debates an artificial intelligence bubble, the structural hardware demand remains absolute. The fund continues to outperform the broader Nasdaq benchmark with a massive year-to-date gain. NVIDIA represents 15.2% of the fund. Its next-generation Blackwell chips are driving an unprecedented hardware upgrade cycle. Taiwan's semiconductor manufacturing company sits at 9.4%. It manufactures over 90% of the world's advanced microchips. Micron Technology holds a 7.8% weight. It captures the massive high-bandwidth memory demand required for these AI accelerators. We see this hardware demand reflected in Samsung Foundry's safe ecosystem. This network accelerates next-generation chip innovation to keep pace with insatiable compute requirements. The Federal Reserve holding rates at 3.63% provides a stable macro backdrop for these capital-intensive operations. While retail fears a tech correction, technicals show a balanced market with an RSI of 47.6. The combined exposure of these three dominant hardware giants creates a highly focused, high-beta vehicle. This structural design means SMH is not a diversified technology play. It is a direct bet on advanced silicon manufacturing, exposing investors to pure hardware risk. Open the hood on the VanEck Semiconductor ETF. The largest single driving, AMD at plus 6.6%, carrying 7.6% of the fund. VanEck sells the SMH ETF as diversified exposure, but 5 stocks control 47.2%. While AUM and expense ratio data are not available in our sheet, the performance demands direct scrutiny. The fund claims an astronomical YTD return of 6,624.1%. This compares to a 3-year average return of 57.5%. This performance is heavily driven by NVIDIA at 15.2% and TSMC at 9.4%. Micron sits at 7.8%, with AMD representing 7.6% of the fund. These holdings represent the physical bottlenecks of global AI computing. Yet, SMH forces investors into a 7.2% allocation in Intel. Intel is a legacy manufacturer currently struggling with foundry execution. Including Intel at this weight is a structural design flaw that drags down pure-play hardware growth. Despite this legacy anchor, SMH outperformed peer XSD by 7.6 percentage points over the last month. While XSD plummeted 11.3%, SMH's heavy concentration protected capital from broader industry weakness. The marketing promises broad diversification, but the reality is a concentrated momentum play. We view this structural concentration as the fund's actual engine, not its diversified marketing label. The Lab's verdict: SMH is a concentrated, top-heavy vehicle masquerading as a broad sector fund, burdened by legacy silicon. SMH is trading at a 2.033% premium to NAV. That's not retail exuberance. That's institutional demand pricing in future earnings before the hardware even ships. The 5-day volume ratio sitting at 0.98x tells us the flow is neutral, but neutral at these levels is a holding pattern, not a pullback. Institutions aren't selling. They're waiting for the next catalyst. RSI at 47.6 and price above both the 20-day and 50-day moving averages. Momentum is still pointed up, just taking a breather. The MACD bearish crossover is noise until price breaks that $574 support. And it's not even close. Now, the narrative filter. The headlines are screaming trade war, tariffs, and Trump-induced volatility. But the fund's marketing still slaps technology on the label like semiconductors are just another SaaS play. That's PR spin. Semiconductors are the hardware backbone of AI, defense, and data center buildouts, sectors that are either tariff-protected or government-subsidized. The lab's verdict: the macro noise is a distraction. The real story is in the supply chain infographic Samsung just dropped. Their safe ecosystem is locking in next-gen chip demand from hyperscalers and automotive OEMs. That's not a trade war victim. That's a trade war beneficiary. Institutions see it. The premium to NAV proves it. The neutral volume flow confirms they're not exiting. They're just waiting for the next earnings print to justify the next leg up. SMH isn't a tech ETF. It's a hardware growth engine with policy tailwinds. The narrative is wrong. The flow is right. The structural engine driving SMH is the imminent 6-month launch of NVIDIA's next-generation Blackwell AI chips. This upgrade cycle acts like replacing slow passenger trains with high-speed bullet trains. This hardware transition secures the fund's momentum, which already delivered a 6,624.1% year-to-date gain. However, high interest rates make the massive capital loans needed to build new microchip factories much more expensive. Furthermore, strict U.S. export controls and potential new tariffs force major holdings like NVIDIA and ASML to redesign products. This geopolitical friction directly impacts Taiwan Semiconductor, which manufactures over 90% of these advanced chips. We monitor technical levels with engineering precision, noting a neutral RSI of 47.6. If SMH breaks below key support at $574.08, then expect a capitulation flush as MACD bearish momentum accelerates. If the fund clears resistance at $634.51, then the extreme fear index reading of 24 will trigger a sharp institutional bounce. Historically, extreme fear precedes strong ETF bounces, so watch for capitulation signals. The lab rates the VanEck Semiconductor ETF a 53 out of 100. This score reflects a highly concentrated instrument where the top 2 holdings command 24.6% of the fund. Do not chase this volatile structure at current prices. Avoid buying until the fund successfully tests and holds its support level. The leveraged semiconductor ETF jumped 7.3%. Lab scores 5100s. Hold. The underlying 3x leveraged index, built on futures contracts, surged 43,271 points in a single session, igniting the ETF's rally. That 43,271-point surge eclipses the ETF's 7.3% price move, signaling extreme leverage amplification that mainstream analysts overlook. We'll dissect leverage mechanics, margin pressure, and policy tailwinds in the full teardown. SOXL surged 7.26% to close at $194.65, fueled by easing bond yields and anticipation around Samsung's upcoming earnings. This engineered instrument delivers 3 times the daily performance of the SMH Semiconductor Index. At the lab, we analyze this as a structural trading tool, not a passive investment. The daily reset mechanism causes severe volatility decay, meaning multi-day holds will erode your capital in choppy markets. Inside the underlying SMH exposure, NVIDIA dominates at 15.2% of NAV, riding insatiable demand for hardware compute. TSM holds a 9.4% weight, acting as the physical manufacturing bottleneck for every major AI chip designer. MU sits at 7.8%, highly sensitive to the global high-bandwidth memory supply chain as the SK Hynix ETF race intensifies. Samsung's safe ecosystem highlights how critical collaborative foundry partnerships are to yielding these complex next-generation silicon nodes. While mainstream media focuses on the massive 43,271.4% year-to-date return, they ignore the mathematical reality of leverage. With the Fed rate at 3.63% and CPI at 0.6% YOY, macro conditions currently favor growth assets. However, the cost of leverage inside the swap contracts still drags heavily on long-term performance. While fund flows show aggressive short-term positioning, The actual holding composition concentrated in these three names creates extreme concentration risk. This 3x vehicle is a tactical weapon for daily momentum, never a buy-and-hold core holding. Open the hood on the leveraged semiconductor ETF. The largest single driving, AMD at plus 6.6%, carrying 7.6% of the fund. SOXL printed a staggering 43,271.4% return YTD, yet its 3-year average is just 93.5%. With AUM and expense ratio data unavailable, we judge this vehicle solely on its structural design. Direxion packages this fund as a diversified semiconductor basket. However, the top 5 holdings command 47.2% of the fund's total assets. This is not diversification. It is a highly concentrated bet on 5 specific hardware architectures. While NVIDIA dominates at 15.2%, Intel represents a 7.2% drag on the fund's overall processing efficiency. Intel's legacy manufacturing struggles actively dilute the pure-play AI growth captured by Taiwan Semiconductor's 9.4% allocation. Meanwhile, Micron at 7.8% and AMD at 7.6% tie the fund directly to volatile memory cycles and PC client markets. When volatility strikes, this structural leverage decays rapidly. Over the past month, benchmark peer SMH dropped 3.7%, but SOXL plummeted an additional 22.2 percentage points. This massive performance gap exposes the daily rebalancing lag inherent in leveraged instruments during market corrections. Wall Street marketing pitches this as a broad sector play. In reality, you are paying a premium fee for a vehicle that decays during sideways consolidation. With the yield curve normal at plus 0.35%, capital is pricing in sustained hardware deployment. Yet, holding this instrument for more than a few days violates its core engineering purpose. The lab's verdict. SOXL is a high-performance tactical engine ruined by legacy holding drag and severe leverage decay. SOXL is trading at an 8.37% premium to NAV. Retail is paying up, but institutions aren't following. That premium isn't demand, it's desperation. The 5-day to 20-day volume ratio at 0.88x tells us the same story. No net inflow, just churn. Money isn't pouring in, it's rotating between hands, and the hands holding it now are the ones least likely to hold through a pullback. RSI at 45.4 and a bearish MACD cross below the signal line confirm the momentum shift. This isn't a pause, it's a reversal setting up. The 20-day moving average at $228.68 is now overhead resistance, not support. Every rally into that level is a short setup, not a breakout. The macro narrative is selling fear. Trump tariffs, trade wars, Greenland. Wall Street's PR machine is framing semiconductors as collateral damage in a geopolitical chess match. That's noise. The real signal is in the hardware. Neural network accelerated nicer pulse profile modeling and resource-oriented quantizer pruning on FPGAs aren't slowing down. AI demand isn't a narrative, it's a structural shift. SOXL's leverage amplifies the upside, but it also amplifies the disconnect between retail hype and institutional capital flows. The verdict: SOXL's premium is a retail trap. The lab is short the premium, not the sector. Trade the flow, not the narrative. Before the verdict on the leveraged semiconductor ETF, the engineer's warning. 3x daily does not mean 3x monthly. A 10% up day followed by 10% down leaves the base index at -1%, but the leveraged semiconductor ETF at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. SOXL has gained 43,271.4% year-to-date, easily outperforming the broader NASDAQ benchmark. This massive growth rests on the upcoming Blackwell architecture chip release. This product cycle supercharges NVIDIA and Taiwan Semiconductor. These top 2 holdings command 24.6% of the fund. The massive corporate rush to build artificial intelligence infrastructure acts like a gold rush. These semiconductor companies are the only ones selling the essential shovels. But leverage cuts both ways. Higher interest rates raise borrowing costs for the expensive financial contracts used to triple daily returns. This rate drag combines with strict export controls on advanced AI chips to China. Threats of new universal tariffs directly squeeze the global supply chains of these chip makers. Any manufacturing delay at Taiwan Semiconductor will instantly choke global supply. Because this fund triples daily movements, that delay will trigger a magnified downward spiral. Currently, the technical indicators show an RSI of 45.4 and bearish MACD momentum. Watch the technical levels closely. If the price breaks support at $184.92, then expect capitulation toward deeper lows. If the price clears resistance at $204.38, then the bullish momentum is back. The lab rates SOXL at 50 out of 100. The CNN Fear and Greed Index stands at 24, indicating extreme fear. Extreme fear historically precedes ETF bounces. Do not buy the peak. Instead, wait for capitulation at support before entering this high beta instrument. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70-30 with SCHD, you keep the sector upside while the dividend side, currently yielding 325%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Top signal. SMH's 53-point hold score hinges on one thing. Die shrink delays at TSMC. Are you holding SMH? Drop your entry price in the comments. Let's compare levels. This isn't financial advice. We're engineers, not brokers. Markets move fast. Past performance doesn't predict future results, and you should always do your own research before trading. We break down the hardware so you can make smarter decisions. Hit subscribe to stay ahead of the next semiconductor cycle. These chips don't analyze themselves. Stay sharp, the lab out.